Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by George Goncalves, MUFG's head of U.S. macro strategy. It's Tuesday, August 5th, 2025. Welcome back to the podcast, George.
Good to be on with you, John.
Yeah, good to have you on as well, and plenty to talk about. I guess I'll start with, the past week was probably like the Super Bowl of macro. You had the Fed, you had the BOJ, you had the Treasury refunding announcement, plenty of news on the tariff front, jobs data, tons of repricing and following both really the FOMC and the employment report. The employment report was on Friday. That I think, if I'm not mistaken, that was like the biggest. If you look at like change in 2-year yields, I think the rally in the 2-year note was like the biggest in a decade or more, if I'm not mistaken. So why don't we start there? So for a while, George, you've been pointing to some underlying weakness in the labor market. Headline payrolls have been holding up pretty well. The unemployment rate had been holding in pretty well, but you pointed to a number of underlying of aspects of underlying weakness. Not like this isn't certainly a good thing, but it seemed to me like the July employment report kind of validated that view. Tell our listeners more.
Absolutely, and I think it's also now brought to light some of the topics that we've been focusing on, as you've kind of highlighted, that we think that, and it's now, I think, being borne true in the data, that the one thing, the NFP model that calculates and the survey approach is proving to be overstating the true reality of the labor market conditions. Just kind of working our way backwards and looking at what we got this past Friday in the jobs report, a negative 258,000 jobs revision only really matched once during the worst of the pandemic. It's very rare to see big revisions like that. Unless you're in some sort of economic inflection point, and usually to the downside, right? Really at odds with all of the sort of narrative around how solid and robust the jobs market is and how strong the economy is when you get something as big as that. But it was not a one-off. This has been happening for the better part of the last 3 years, almost 4, where almost every single year the average revision has been negative to the monthly job readings, again, hinting at a sort of model bias that's overstating the reality on the ground. But again, 3 months in a row now of jobs well under 50,000. And if you were to remove the healthcare and education elements, you actually had negative private sector job growth in the last quarter. And as we've been kind of taught over our careers and in school, 3 or 4 months is roughly a trend. And now we have a trend of economic weakness in the labor market. Is it the end? Is it the worst of it? We don't know, but it is consistent with this idea that the jobs data has been overstated, and even within it, the composition of the jobs data has been skewed away from private sector, more towards government and non-cyclical industries like healthcare and education. So yeah, there's a whole host of things that we look at, and clients that receive our content and conversations we have over the years. We've built this case up, and I think now it's kind of coming to light.
Yeah, very, very much so. I think, you and I talk about this in client meetings and as well as on the desk, but there's been even the unemployment rate's held in pretty well, but that masks a decline in labor force participation, a lot of sort of weakness under the hood, if you will. To kind of continue on this topic, you talk about this a little bit in your recently published Macro to Markets Outlook entitled At an Inflection Point or Another Macro Head Fake. You also have a number of other quote unquote special topics. I liked, all good, of course, George, but I liked the rhetoric versus reality of tariffs and trade details, or trade deals rather. Could you take our listeners through, maybe one or more of those topics? Obviously we're constrained on time, but at least kind of hit on some of the high points.
Yeah, some of the high points are that based on where risk markets are, which are pricing towards kind of like a Goldilocks, a sort of virtuous growth cycles ahead of us. A lot of it on the back of the AI story, spending deregulation that's coming, there is, elements of uncertainty that are potentially lifting, although you could argue we haven't felt the full brunt of the tariffs yet. And that could still be disruptive to the economy as well as consumer behavior. But if you put and then of course markets are still near all-time highs for a lot of different asset classes, and valuation metrics very stretched. So like that is giving us a kind of like a mixed signal. But if you look under the hood, the data trends suggest that we're potentially entering into another, even if it's temporary, stagflationary environment where we've probably seen the best of the declines in the inflation trends for now. And there is some base effects as well as potential pass-throughs of inflation price increases from tariffs that, ironically enough, those that have been following our work, we are typically known as the more dovish house on the street. We've been calling the Fed should have been cutting. They should have had cuts already in place, but now the window is potentially closing. We had the Fed last week as well. It feels a little bit out of context given their messaging versus what we got from the jobs data. So like we're in this weird spot where like the data might not be bad enough for them to cut a lot, but at the same time they should have been cutting already. And we'll see a few more cuts this year and then more next year. So that's like the other section that I encourage everybody to kind of go through in the monthly. It has an update on our Fed view as well as kind of this macro intuition. On the trade deal discussions, we took a different take on this rhetoric versus reality of tariffs and trade deals. One, I think we just don't know, the full details of these trade deals. There's term sheets. There's a number of agreements have been had bilaterally amongst countries with the U.S. But on average, the effective average tariff rate is kind of creeping up now above 15%, probably getting close to 20, somewhere in the middle. Maybe it lands around 18. And we're talking about 18% tariffs. These are massive numbers that, if they were mentioned in any other time period, would have been a shock. And the market's been pretty sanguine on what that means. I think largely because it's hard to forecast and predict what it's going to, the unintended consequences, as well as maybe some good consequences that might lie ahead. And so there's like this kind of a disbelief or just not fully acknowledging that these are really big tariffs that could be disruptive to activity. But on the other side, what we also looked into is that there is potential for this being a revenue raising opportunity for the U.S. government if these tariffs remain. And so if they're binding and we don't see them overturned, or if nothing were to get renegotiated, which again, everything's possible in the world that we live in right now, it's all about deal making, so that we could always see the tariffs change. But at these levels of somewhere between 15 and 20%, the U.S. government can collect ranging between 350 to 550 billion in revenue per annum if there is a substitution effect. And if there is, it'll be more towards the lower scale. But we're talking about some really big numbers, and roughly about a quarter of the current deficits that are running closer to 2 trillion, right? So you can knock out, almost 500 billion from your deficits. That should be actually a fiscal positive, right? You're actually, that more than pays for the big beautiful bill, and especially for the additional tax cuts, and partially pays for the extension of the tax cuts that were from the 2017 TCJA. So like there's definitely there's positives if the tariffs remain in effect, and if they don't get unwound, there's going to be a revenue benefit coming back to the U.S. government. But then then we kind of conclude with a flows discussion where there's also, over time, going to be less dollars circulating outside the U.S., and therefore, by extension, less reinvestments from foreign investors back into treasuries, which then really shifts the burden to domestic investors having to buy and really pick up the slack of treasury supply and buy more treasuries going forward, which might compete, the old crowding out effect that we know from textbooks, and how that might impact other markets' valuations. So it's a lot said there, but definitely we did a pretty big deep dive into tariffs. May have one very silver lining, which is the revenue raising.
Yeah, that was great. I mean, it's a great piece. It's a dense piece, but I think that was a pretty good pretty good summary of a number of the important sections. But let's move on. So we've gotten past the Super Bowl of macro. Last week we're going into like sort of the doldrums of August. Kind of prime vacation time. So August is traditionally a slower month, but there have been some notable inflection points. Last August, price action was pretty significant. You have a number of events. Jackson Hole always garners some attention. So for our listeners, heading into a holiday period with low liquidity, less going on, but some important events. How should people be looking at things? What should they will be watching out for? What's your base case for the next 2 to 4 weeks, and what are some of the tail risks?
Yeah, I think the starting points matter. We're entering in with, even though we've seen some episodes of vols are still pretty low. Valuations again are pretty stretched, and so it wouldn't take much in the sort of kind of low volume, low liquidity environment that August usually typically is to see markets take a breather, at a minimum see a pullback, especially in risk assets, starting with with credit all the way up to equities. Everything's pretty tightly wound and I think still priced to perfection. And so I wouldn't be surprised seeing some sort of consolidation, a pullback in that sort of environment. There's really no positive catalyst to the upside unless, again, really only if there's just no really bad news and you get just a natural kind of flow effect that pushes up assets. But otherwise, there's really no catalyst either way. And therefore, that creates more asymmetrical risks to the downside, because if something were to come out of the blue and really, kind of question markets' convictions, you're more likely to see downside risks than upside risks. So watching the data flow, watching overseas markets, and if there's any sort of like bigger moves, and we're obviously watching very closely Japan-related markets and long-term rates around the world, if that were to be a catalyst. So I'm more concerned about that. We have CPI ahead of us.
Sorry, and you also I think you mentioned this earlier. We definitely talked about it in the piece. You think that now that the rates market are sort of more correctly priced, but you talked about how full risk assets are. So presumably that's a risk that we should be watching out for too.
Yeah, exactly, and that's the interesting. Like you mentioned at the open, how large of a move that we saw in the 2-year Treasury after NFP goes to show you how quickly rates markets can get back on sides with what at least for now, what the macro conditions are telling us, that perhaps things are not that good. So rates,
right. And perhaps risk assets as well, right?
Exactly. So like if this was just a shot across the bow and there's no follow through, but if we get further confirmation of macro weakness and or some other negative catalysts, I think that the area of the markets that's most prone to readjust is going to be now risk assets, because they're the ones that are in most denial in our view.
Yep. Yeah. Good point. Anything that I interrupted you a little bit. I think you were going to talk about CPI.
Yeah, CPI. So let's see if CPI, because everyone's now laser focused on the pass through. If there's not pass through on tariffs, then if get further decline in rates, or if there is evidence, that could be enough to impact the risk assets more so than treasuries. And then there's Jackson Hole, like you mentioned. And unlike last year, which one of the big drivers of our view, which I know you are keenly aware of, the QCEW revisions don't happen in August. They actually happen in September after Labor Day. So that piece of information, which was really critical for changing Powell's stance last year at the Jackson Hole, if you remember, they basically did a 180 like last year, July. It's almost like a deja vu of last year, as we've been talking to clients about it, that it looks very similar to last year, but for different motivating factors. That they were very sanguine in July, and then they flipped the script in August, and then September they cut by 50. I don't think they have the same conditions like that, but we do think that the September is pretty much now a lock. It would take a lot for the Fed to not cut rates, or the data would have to turn tremendously in the next 3 to 4 weeks.
Okay, got it. So watch out for for some illiquidity and some challenging trading conditions that could cause markets to reprice quickly. Watch out for CPI, Jackson Hole. The Fed won't have the benefit for those of the QCW data at Jackson Hole, but they'll have it before the September meeting. Is that correct, George?
That's right. So the NFP and the QCW before the September meeting, I think will really drive home the cut.
Great. Awesome. Well, great stuff as always, George. For our listeners, I would remind you to check out George's macro to markets outlook entitled At an Inflection Point or Another Macro Head Fake. And if you are not receiving George's strategy reports, do check out the MUFG research portal at www.mufgresearch.com, where you can find all your favorite MUFG research, as well as sign up to have it conveniently delivered directly to your inbox. Great stuff as always. Thanks, George.
Thank you, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.